Hi, folks that are joining us tonight. Give us a few more minutes to allow people to get into the call, and we will get started momentarily. I think we'll get started. I think we'll get some stragglers once we get into this. But my name is Bob Cohen. I am a SCORE mentor, and I appreciate everybody joining us tonight. And we'll get started right away. With me tonight is Dave Jazewski. He is the President and CEO of Comstar Credit Union, and he'll be talking to us tonight. So let me just go through some slides about SCORE first, and then afterwards we'll get to David, and he'll go ahead and start working through the presentation for tonight. So just want to talk to you a little bit about SCORE. For those of you who are not familiar with SCORE, our mission is to foster small, vibrant business communities through mentoring and education. So basically, one-on-one, two-on-one mentoring, and as well workshops like the one that we're doing tonight. But you all know that for the most part, small business drives a good portion of the United States economy. And so it's really important not only to the SBA, who's one of our partners, but to the entire federal government that small businesses thrive throughout their communities. So with SCORE, we are all volunteers, and our volunteers give their time and energy to help other people. So everything that we do is free of charge. So what is SCORE? We're the largest network of free business mentors in the nation. So there's about 250 chapters nationwide with somewhere around 12,000 volunteers. And SCORE in Cleveland has about 90 volunteers that work with clients who are interested in either growing a business from scratch or growing their business that's already up and running. And that's why we bring to you the types of workshops and webinars as well as our mentoring. So SCORE is for everyone. We've got areas on our website for Black entrepreneurs, for Hispanic entrepreneurs, for women, for veterans. We really do try to empower entrepreneurs to succeed, and we try to help everyone that needs the help. All you have to do is ask for it. And that we're here to make sure that you get the information that you need to make sure that your businesses thrive and are successful. So I wanted to just kind of go through some stuff. SCORE in Cleveland, I mentioned that we have 250 chapters throughout the country. We have been chosen as the #1 chapter. We're chapter of the year. And one of the reasons why is because the success that we've had starting small businesses and creating jobs and offering up services to the community. So as you go through this workshop tonight, I encourage you that if you need help with your own financial situation pertaining particularly to finding funding and financing. We are not a funder like the SBA or some of the other resource partners, but we surely can help you resource and find those and help you to get to a point where you've got a good, strong business plan. Dave will talk about that, as well as good application to get successful with your funding and your financing. So one last part of this is that we all sign off on a code of ethics every year to protect our clients, and it's a real priority for us. And you can see that we're not permitted to make money. We may not use your client information for any commercial reasons, and anything that we do is confidential, and it's held protected by the U.S. government. I mentioned our services are free, and that is in part because we are funded through the federal government. We also raise our own funding um, on a basically an area-wide basis to help us support the work that we do. So I'd like to turn it over to Dave. First, let me just show you our website. I'm going to our website. It's live right now. There's a bunch of things you can find out. There is a brand new, if anybody is working with circular businesses, circular meaning being able to reuse, revitalize materials that typically might get thrown away. There's a grant program that is just starting up this week. Today's the first day of the announcement of it. They're awarding three $10,000 grants for either startup or businesses that can help work on the environment. So if anybody is in that space, I recommend that you come to our website, pull this up, and then take a look at the application form. I think the applications are due by the end of September, but take a look at it. But what I really wanted to show you is that if you go to our website, this is our homepage, there's a lot of resources on here for you. Browse the library, take a workshop, and you can look at the workshops that are coming up. But more importantly, if you're looking for a mentor, you just hit the Find a Mentor button. It will pull up another screen. You put together your zip code and some of the other information that's here. Tell us a little bit about what you're looking for, what you need, and we will contact you generally within about 48 hours. So I'm going to go back to the presentation, and I would like to again reintroduce Dave Zesky, who is President and CEO of Comstar Credit Union. This is the third of his series, but this has been a great series. Everybody that's on this call tonight will get copies of what Dave's going through, as well as this actual video. If you have any questions, please put it into the chat or in the Q&A box, and we'll try to get to everyone that we can. So here's Dave. Thanks, Dave.
Thanks, Bob. I appreciate it. And thank everyone that's on the call for carving out some time to talk with me tonight. This is part three. Part three of the presentation kind of builds on the first two parts. In the first part, we talked a little bit about different types of business banking structures, business plans, how they're created, what types of loan documentation financial institutions are looking for, and why it always seems like they ask for more. And then we also talked about the different documentation standards if you do in fact go with the SBA guarantee route. Then in part two, last week, we talked about the presentation between your relationship with your business banker and their business lending committee, and how they score the risk that they feel is in the loan application itself. And then we talked a little bit about risk buckets, buckets that have a lot of risks to financial institutions and buckets that look that they have less risk to financial institutions, and how that changes your risk score. And then after that, we talked a little bit about mutual beneficial structuring. So the relationship between the financial institution and the borrower as it pertains to the loan, and the differences between conditions and covenants and the formality of commitment letters. Now, if you have any questions, and if you sat through those two parts and questions come up, please put them in the chat. And my commitment to everyone this evening is to stay on until all our questions are answered. And also tonight, if we finish up part three and sometime in the middle of the night you wake up and say, "Oh, I wish I would have asked that question," my contact information will be at the end. But so feel free to email me, and if I can't get you an answer, our business lending team will definitely get you an answer. So, one of the things that we talked about is how the business lender, it wants you to be successful. and obviously wants to originate loans for the financial institution. And the financial institution also wants to make sure that they make sound decisions that's good for the borrower and good for the institution. But then you always hear this kind of phantom menace, so to speak, called underwriting. And underwriting is a very important portion of how the financial institution sometimes makes final decisions about the risk and approval of your loan. And I call it the dream killer because sometimes underwriting does that, but it's not something that's specific to credit unions or community banks or commercial banks. Pretty much across the board, everyone understands that underwriting exists. So we're going to start there and just talk about that function. So one of the things that I always tell my team is that we try to get to yes, right? So sometimes people from our lending department, they might talk to our chief lending officer or myself and just kind of give me an idea what we're looking at and how we can get to yes. And sometimes on this screen, I want to go through what happens. So sometimes they'll ask for information that you thought you submitted already. One of the things that's frustrating is not being on the same page with your borrower and the borrower not being on the same page with the lender. And so sometimes you might think that they're asking for information, but underwriting may want to look at that information in a different way, or maybe it took a while for you to get your environmental assessment done, and the underwriting might think that now the information is, let's say, for example, you had to do a phase 1 environmental, and that takes a long time to get done. And so underwriting might say, hey, some of this information that we have is already 6 months old, so we want to look at it again. And then sometimes underwriting, they ask for documents that you might think are irrelevant. And that's fair. Before I was in banking, I owned a small business, and I had thoughts like that sometimes. But all I'm going to say is be patient with underwriting. The reason why they exist is because they have no, I don't want to say they have no emotions. They have no emotional investment in the loan. So you, as the entrepreneur, the business owner, or you're thinking about starting a business, you have a lot of emotional investment in that process. And then the lending institution wants you to succeed. It's good for you. It's good for them. And they've been talking to you about your business plan and your documents. And so they have a lot invested also. But underwriting doesn't have that. So underwriting is just a kind of a non-invested entity that might look at things different than the way that you and your business lender look at it. So you might think that's irrelevant, but there's usually a reason why. And don't be afraid to ask them. Now, typically, you will never have direct conversations with underwriting. Typically, that'll all go through whatever business banker or business development officer or whatever their title is. They'll deal with underwriting directly. And so sometimes that gets a little bit confusing, especially if that person is asking you for these same things. But that's kind of the process. And then they demand explanations of your explanations. One of the things we talked about early on is the idea of how transparency and mutual benefit and developing a relationship with your financial institution and your business banker, how that builds trust. Okay. So when you build trust and you have great rapport, sometimes things aren't as black and white, or you might think that those things are very obvious, but to underwriting, they are not. They've never met you before other than what they're looking at on paper. So sometimes they'll look at things and say, well, tell me why this is this way, those kind of things. So like I said, you have to be patient. I kind of jokingly put they don't have feelings. That's not true. They do have feelings, but underwriting is evolving, and it's evolving because of the demand for speed. So sometimes, depending on the loan size, there'll be certain dollar thresholds where underwriting is starting to become an automated process. So in the automated process, you can, you hear the term algorithms, and software can be built where it puts things in categories and it spits out scores, or it spits out questions or recommendations. And those software definitely don't have feelings. So the reason why some financial institutions do that is because they're trying to get your funding to you faster. So just keep that in mind as people want their business to get rolling as soon as possible, and underwriting sometimes slows the process down, but also depending on the dollar amount, it might go faster just depending on if it's automated. Some financial institutions think that's a sound way to do it, and some do not. They have the power to say no. So typically, and I have seen it happen, but only once. Typically, if underwriting denies the deal, so let's say you've gone through the process, you've gone through the application, you've gotten all the documents, and you've talked to your business banker, and the business banker's business loan committee has said, you know what, that looks good. I think there's a deal here. And so they give you that commitment letter, and you sign it, and they sign it. And if you were here last week, remember we talked about the importance of getting a commitment letter, not just some cursory pre-approval, because the commitment letter is that it spells out the rest of the process and then the terms that would be at the end. But underwriting does have the power to say no, and they will give the financial institution a reason, maybe multiple reasons. One of the interesting things about underwriting is when financial institutions score a business loan, typically that score falls between a 1 and a 10. 1 being super perfect, kind of this unicorn loan application we never see, and a 10 being all risk and extremely unlikely to get funded. So most deals that get funded kind of fall between 3 and 7, all right, in that scale. Now, typically, things that I see come back from underwriting denied, they might score them a 7 or 8, and then the financial institution may have scored that, let's say, a 3 or a 4. So that's a very large deviation. And typically when that happens, the underwriting and the financial institution, they have a discussion about what each person saw and why they scored it the way they did. And sometimes that happens before they go back to the borrower and say, yes or no. So I've not seen it very often. I have seen big deviations. One thing that I've seen one time is there was a deal that underwriting didn't like for one reason or another, but the financial institution liked the deal. And so underwriting recommended no, and the financial institution funded it anyway. I will tell you, that is a super rare occasion. And the reason why is because every financial institution has a regulator, whether that's the federal government, the state government, however the financial institution is insured, federally insured, privately insured. So they get audited, and their loan files get audited. And one thing that will always raise a red flag for a financial institution during an exam is to go against underwriting's recommendation. Now, that financial institution thought that was a justified funding, even though underwriting didn't, and they'll have to have that conversation with their regulators. But because that will be a comment or a finding in a regulatory audit, it's very rare occurrence. On the other side of that coin, they have the power to say yes, but they might have new conditions. Now, if they say yes as presented, golden. You and your business lender have done your homework, done everything, looked at it the right way, and underwriting said, yeah, this looks exactly how it's presented. We feel good about it. Rock on. Now, sometimes underwriting would say, we would approve this deal, we would underwrite this deal, but I have a new condition that I want you to add. And that condition might be that the borrower is not allowed to incur more than $5,000 worth of new debt in every year. So let's say, for example, you got the loan and then the following year, you got one pizza oven, and the following year you needed some other piece of equipment, and that piece of equipment was $10,000. But in this new condition, if it has $5,000 worth of debt, you have to go back to the lender. And so you do all those things. Now, if underwriting says yes with new conditions, you have to agree to those conditions before you close. All right. And maybe you can live with those and maybe you can't. That's a discussion between you and your business lender. But if it ends up in your loan documents, that condition, and you agree to it, and then there's a annual review and you've not met that condition, sometimes that new condition becomes a reason for default. And that sometimes has consequences, like it changes your interest rate, those kinds of things. So don't be afraid of new conditions. Just make sure that you agree to them and you can live up to them, moving forward. So, and then lastly, on this slide, to get to yes, the banking relationship becomes the liaison. So we talked a little about emotional investment. So between underwriting and your decision, your relationship with your banker is your biggest cheerleader, is your biggest soldier for this application. So if you aren't being transparent and honest and building this relationship from the get-go, you just have to know that sometimes they may be more or less willing to fight for this deal, depending on how that relationship is going. So like I said, be patient. Underwriting has never looked at this deal before it was put on their desk or fed into their computer or however they're doing it. And so you just have to understand that it's a completely separate entity. All right? Okay. So the next steps. Do we need an addendum to the commitment letter? So typically the commitment letter spells out all the final terms that will happen before the closing of the loan. If you and the business banker agree to any new covenants or conditions that come out of underwriting, I would suggest updating your commitment letter to show all of those things. And that could be just a simple addendum, or they could rewrite the whole thing, whatever. But I would make sure that those were spelled out on a separate document, and make sure that you've signed it and the financial institution has signed it. And then also in the real estate world, is a lien search going to be needed or updated? So sometimes banks or credit unions or whatever, they like to make sure that projects don't have encumbrances, whether it be past taxes due, or let's say there was remodeling done and the contractor that did the work, they want to make sure they got paid, and so the contractor doesn't have a lien position that would be superior to the financial institution, because typically they like to be in the first position. That way, if there's default, they're kind of the first in line for the collateral. Surveys and flood certifications. So, we've gotten a lot of rain lately, and, flood certifications are important to make sure that the collateral and what you are borrowing against hasn't had flood issues, or if they have had flood issues in the past and they're in a flood zone, that those things are either remediated or insured correctly. Now, surveys are interesting because there's different types of surveys, but one of the things interesting about surveys is what you find out about boundaries. I've seen a couple of commercial deals where they've had mutual access driveways, and one of them is kind of encroaching the other one's space. And sometimes all it is a simple agreement or conversation between the two business, like, yes, I understand that, that marker is a few inches inside, that kind of thing. So you just want to make sure that those surveys are clear of any kind of weirdness like that that could pop up later, that could cause the borrower problems. And the more problems the borrower has, the more they have to concentrate on solving problems instead of running their business. And then the appraisal. I always get questions about appraisals, if appraisals are needed and when should they be done. So it really depends. And here's kind of the standards that I use. First off, if I had a business, I'm going to have some amount of equity ownership in the stake of the success of this loan application. And some of that money I might earmark for appraisal and say, okay, right off the bat, I know I need an appraisal and I'm going to pay for that. Now, that appraisal might come back not great for you. It does happen where they find something or the value is not there, that kind of thing. And then there's kind of negotiating pieces and maybe that deal falls through and you're out that initial investment. To me, I've done enough homework and I think I'm where I need to be. And I don't want to wait another 30 to 45 days for an appraisal to come in once all of the rest of this has been underwritten and settled. So you look at kind of, people are like, look at the real estate market right now. People are saying, well, okay, rates are going up a little bit, the housing market's cooling off. But literally a month ago, rates were lower, there's no inventory, people are paying a lot of money for real estate, those kinds of things. So appraisers are busy. And business appraisers are even harder to find than consumer real estate appraisers. So their schedules get backed up quickly. So so that's my investment. I know I'm going to have that appraisal. Now, there's some thinking that says don't put any money up front if you're going to get a denial. Okay, I see the value of that too. That you've gone through this process and appraisal denies it, the financial institution denies it. So some of these appraisals are thousands of dollars. So I understand that part too. You just have to know that there's a timing element and whether or not that timing is worth the investment. Okay, closing documents. Are the closing documents ordered? Well, if you have a good relationship with your business banker, they would tell you exactly when the closing documents are ordered and when the closing documents are going to be dated. That's important for when you sign, because typically you want to see, especially if it's real estate, you kind of want to see a disclosure before you close about, all right, here's the appraisal, here's the survey costs, flood certification costs, lien search costs, title work, all those kinds of things. So you want to make sure you understand that timing and the dating of the documents. One of the things that's important about the dating of the documents is that's your date you're going to sign. You don't want to get into a situation where all of a sudden you have to go back and order another set of closing documents. Now, typically, if it's the financial institution that has to delay it, then they'll pay for reordering closing documents. But if it's the borrower, then that's added expense. And then, did you review them? You should have adequate time. And my idea of adequate time is different than your idea of adequate time. I look at closing documents and commercial loan papers a lot, so I kind of know. But for someone who's never done it before, it's daunting. It's a lot of words and there's a lot of stuff in there. And I would review those. The worst thing that could happen is to schedule a closing, you get to the closing, and then you haven't really reviewed the documents, and all of a sudden something pops up in the wording of the documents, and you're starting to ask questions at the close, and then all of a sudden things start to unravel because you understood something one way, the business banker understood it a different way. That's very uncomfortable. And so I would make sure I reviewed and cleared up any of those questions before I scheduled that closing. And then typically you would get a clear to close, which means, you know, all chips are at the center of the table and you're ready to go and you've scheduled the closing. And the other thing about closing schedules is make sure that all the attendees that need to be there are available. So if you're running a business that has a minority partner, but that minority partner has a more than 20% interest, they might have to be a signer. So you just have to make sure that, especially if they're out of state, if you have to do an out of state notary, overnight documents, those kinds of things, that part of the closing is scheduled. All right. All right, so this slide touches base a little bit on what we talked about last week. The score matrix. So like I said, 1 to 10 or 1 to 8 is very typical, and most underwriters like things that are 2 to 5. I've seen deals that are 6s and 7s on the 10 scale get funded, but once they go into that 8, 9, 10 range, not very likely. Of course, underwriters like things that are scored a 2 because there's almost no risk in the deal. I've seen deals that are a 2 that are scored a 2. It's not very often, and they usually go by, they go get to funding pretty fast. But most of the deals that we see are in that kind of 3 to 6 range, and underwriting likes those 2 to 5s. And then sometimes you have to negotiate to get them to see it the way they scored. So scoring factors, if you missed out, first off, your debt service. Well, what does that mean? It's basically the ability for the business to service the loan and make the payments, and not only service the loan and debt of the business, sometimes they look globally. So that means that they look at the owners of the business. How do they handle their debt that's not the business debt? Those kinds of things. So credit scores, yep, they look at credit scores. LTV, which stands for loan to value. Am I buying am I paying $20,000 for a pizza oven that's worth $50,000, or am I paying $20,000 for a pizza oven that's worth $10,000? Lot different scenario there with risk when it comes to the loan to the value. Score versus score. That's just what I talked about. How does the financial institution score the risk versus underwriting? Business profitability history. So for people who have startups or things that are less than a year old, you can go into an industry code and you can look at a very like business, and it'll give you scenarios of profitability and histories of profitability in that sector. So some financial institutions will look at that and say, okay, I don't have any more than 8 months or 12 months worth of info. I might have no info to give them on profitability, but here is this business model that's been around for X amount of years, and here's how that normally operates. So don't get scared about that. There are resources to make that argument. Past loan performance. Very important to pay your bills on time, and to make sure that it's known that you're a good borrower and that you have good relationships with your lenders, regardless if that's on the business side or the consumer side. That's very important. And then SBA guarantees. If underwriting is presented with a SBA guarantee loan, they'll want to look at the things that made it SBA eligible, because the SBA has different eligibility than conventional business lending, and so they'll just want to make sure that all those bases are covered so that the loan is guaranteed, or at least a majority of it. Okay, now here's the best part. You're approved. Well, that's awesome. So you got the clear to close. Yes. You understand disbursements. So sometimes financial institutions will say, all right, I understand that you're going to be buying X, and then you're going to be doing a leasehold improvements, those kinds of things. Sometimes the financial institution will actually handle those disbursements. So this person gets X dollars out of this loan, this person gets X dollars out of the loan, and then you get the rest for capital, working capital, or what have you. So that's another conversation you have to have about how and when the disbursements are going to go out. Lender fees are collected at close, notaries, the signing day, title policies on real estate usually come later, even though a lot of title companies will do commercial closings. It's very common. The actual policy for the title takes a while to work through the system and get back. But if you don't have it back after, I would say, 60 days, I would definitely talk to the title company that you did your commercial closing with and find out where your copy of the policy is. And then docs completion. So docs completion is you get signed copies, the financial institution gets signed copies, the title company might get signed copies, those kinds of things. So all that is completed. And that's awesome. All right. So now you can go out and build your empire. So congratulations. One thing I think that is not talked about enough is what happens next. So you've gone through this arduous process and you've got the money, you've done, you're growing and expanding and building your legacy, but kind of what happens after the money? So first off, loan officers, business loan officers, they don't want to be a pest. They want you to run your business and make your money and expand and be successful at your pace. Okay. They want to be a partner. So certain business loans, depending on the dollar figure, you might have to have a review every year. Okay. So, well, what do you mean? I paid as agreed. I paid every month. That's true. But on the consumer side, if I had a car loan and I made monthly payment every month, the chances are you're probably never going to hear from that financial institution because you're paying as agreed. Commercial lending, completely different story. They'll do annual reviews. Now, if it's a small enough number, they might not, but just be prepared for that. So why do they do it? A couple of things. We talked about covenant enforcement. Are you living up to what you said you would do in the loan documents, which may be more than just, hey, pay this on time? Submission of documents. Every year, most financial institutions will look at, hey, I'd like to get a copy of your business tax return. I'd like to get a copy of all the business partners' personal financial statements to make sure that you didn't take on, too much debt with that new Ferrari you bought. Those kinds of things. They want to make sure that the risk of non-payment is not there. And then is repricing allowable? So sometimes you pay for a certain amount of years and the loan might say, well, your rate is tied to prime. The prime Fed rate plus 2% or minus 50 basis points or something. All of that will be in your documents. So they'll be reviewing whether or not that repricing is allowable. Payment history, we talked about that. Oh, SBA fees and reporting. So some SBA guaranteed loans have monthly fees, and those monthly fees have to be reported. And then if the SBA has any like adverse notices about the performance of the loan, those kinds of things, that reporting will flow through the financial institution to the borrower. And so part of that annual review will have that in there. And then a participant's review of an investment. So if you were with us last week, we briefly talked about this idea of loan participations. So let's say, for example, you went to credit union and say, hey, I need $1 million. And the credit union says, okay, I understand you need $1 million, but I'm only allowed to lend $500,000 to an individual borrower or a business. However, there's another credit union that also does business lending. So I'm going to ask them if they want to invest the other $500,000, and then we fund the loan together. So in that scenario, in that happens a lot more than you would think, especially when you start talking about deals that are, million plus real estate holdings, those kinds of things. So some of those participants, they want to see every year that their piece of the investment of the loan funding is solid. And so they might ask for a review every year through the credit union or bank that you got the loan from. They kind of are like behind the scenes, but they did put money in to help you get the loan. So sometimes they ask for that. Okay. Now, about 6 months to a year out, here comes your term date. So in your loan documents, you might have what they call a termed out loan, which means, hey, I had 10 years to pay back $100,000. And at the end of the 10 years, that's it, I'm done. Okay. Some loans, very common with business loans, we talked about this in part 1, is the idea that we might amortize a loan out 15, 20 years to help you with cash flow, but the actual repayment term might only be 5 years. And then after that 5 year, it's time to, look at where's the rate, have you been a good borrower, and you're kind of renegotiating the loan. It's very common. So number one, the importance of being a good borrower. And being a good borrower is more than just making your payments every month, although that's a very big piece. So another thing you have to remember is the lender is not obligated to renew that loan if you have a term before the loan is fully paid. So you might ask, well, why not? So here's a couple of reasons. Let's say, for example, financial institution, they decided 5 years ago that they were going to put $10 million into investment real estate funding. And then it was such a popular program that now they have $11 million in that bucket that they had available. Well, they might say, hey, look, we can't renew that loan because we are over the amount of money we set aside for that bucket. So the concentration of our business loans in one industry or one category is carrying too much risk. So I'm sorry, you've been a great borrower, but we just don't have the capacity to lend to that industry. Now, if they're a good financial institution, and I've experienced this on both sides, they will help you with financial institutions that may have capacity for those kinds of loans. Okay, market forces. So there could be things that are driving them to want to be in certain types of lending and not in certain types of lending. So when you are starting to have conversations with a financial institution, you kind of want to get a feel for, is this industry that you're talking to them about, is this something they deal with? Do they understand it? Because a lot of times the scenario I've seen is that the loan is good, but they are unfamiliar with that. And then they want, when your term comes, they might want that money to fund things they're way more comfortable doing, even if you're a good, even if you're a good borrower. So sometimes those market forces and the priorities of the financial institution sway decisions on renewals. And then rate priorities. Let's say, for example, 5 years ago, you got a business loan at, I don't know, let's just say 3%, just for argument's sake. And, we've seen what's happening with the Fed. We've seen what's happening with interest rates. Business lending follows. So let's say, for example, now businesses are borrowing for 8%, just for argument's sake. So financial institution might say, well, I know the borrower, they'd like to borrow at 3%, but I'm going to have to charge them 8%. So because that's what I can get right now. And so you as a borrower might say, well, that's not very competitive, but the lender is not obligated to renew that loan at the same terms that you borrowed against. So there might be, depending on how things are going economically, there might be a large shift in rate. So that so just remember, the length and the requirements of this process, because it starts all over again. So there's two trains of thought on business lending. There are some financial institutions that will always renew, do a 5-year term, renew, do a 5-year term, renew, and so on and so on. So it feels like you never pay it off. There's some financial institutions that say, okay, we'll do the first 5 years, and then when we do the renewal, we'll look at, all right, how much is left? Are we going to term it out? And what I mean by term it out is at the end of the next set of loan payments, it'll be completely paid. And then on the SBA side, the SBA has some very strict guidance about how long the term of the loan can be, and it being 100% paid off at the end of that loan. So that's also a conversation to have about, is that a benefit to me? It might be good so you don't feel like you're paying for a long time, but your cash flow might be impeded. And then Bob, I think you jumped the slide a little early. So be market smart about the rates. So if you know that in the next 12 months or the next 24 months, rates are going to be going up and you have a business loan, even if it's 24 months out, I would suggest having conversations about, well, maybe I could renew my loan early and not be impacted as much by interest rates. Or maybe I want to go as close as possible to the end of the term to renew, because I know interest rates are going down. And the longer I wait, the better advantage I have for interest rates. So you just kind of have to know those things. And then be equity prepared. Loss of collateral value or cash flow shortage. So let's say you've run your business for 5 years and you've been barely breaking even those 4 out of those 5 years. You're still paying as agreed. You're still got your head a little bit above water. A financial institution might say, hey, we're only comfortable at this amount of profitability and you're like just above water, so we'd like you to inject some equity to pay down the loan so that it shows it to be more profitable with your payments. Or if the collateral value has crashed, let's say somebody wanted to buy a bunch of Beanie Babies, if you remember that craze, and so they invested a lot, and then a few years later, nobody wants those things anymore. Now maybe that's going to come back into fashion, I don't know, but the financial institution might say, wow, there's a lot of risk there because there's not a lot of demand for that collateral, so we're going to need you to pay it down to what we think the collateral is worth now. So just know that that's a consideration. And then term out scenarios we already talked about. So, all right, next slide. Here we go. So earlier I was talking about kind of the evolution of business lending technology and underwriting technology. So when I first made this slide, I guess I might call it worst case or old school scenario, but we are getting faster. So on the left-hand side, it's kind of the what, and the right-hand side is about how long these things take. Now, remember, you can do some of these things at the exact same time. And we talked about, the appraisal and those kinds of things. So the business loan packet preparation, if you work with SCORE and the business plan's finished and the SCORE mentors have helped you put a really good presentation together, that packet presentation might be less than a month. A loan officer's review of the packet, if it's complete and they're not chasing you back and forth for information, that could take a week or less. And then the loan committee, depending on if there's participations involved in your loan, that could be less than a week, but it could go up to 1 month if it's a really large deal. Underwriting, typically over 50,000. Some financial institutions, it's over 100,000. It depends on which one you're dealing with. Underwriting can be a week or so. Typically, if it's under 50,000, that's becoming more and more automated or very easy to fund. That might be a day. Environmental is such a wild card. So if you did a Freedom of Information Act on environmental and you filled out the questionnaire and it's a relatively small loan size, you could have that information back in a week or two. Now, if you do that questionnaire and get information about, the parcel that you're looking at, and there are some issues, and they ask you to do a phase 1 or phase 2, that can take a very, very long time. And sometimes in very bad scenarios, you might have to get some brownfield funds, EPA stuff, and that takes a really, 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 really long time. Now, but fair warning, if you become in chain of title a piece of real estate and you haven't done your environmental due diligence, and then something happens, you own it. Doesn't matter who owned it 100 years before you or what they buried there. The cleanup is yours, your responsibility, and that is expensive. Okay, title work, couple weeks, 2 to 4 weeks. Documents, couple days, doesn't take long. Documents are, pretty much automated generation now. Once the commitment letter is signed and everything's agreed and it's through underwriting and you pick a closing date, they can spit those documents out almost the next day. So, and then funding. Funding, it can happen rapidly once the closing is done. But one of the questions I always have is, well, there's rights of rescission, or, I get 3 days to change my mind, all this kind of thing. That may be true on the consumer side, not so much on the commercial side. So if it's on commercial paper and you're worried about rights of rescission, I would definitely talk about that way early, like in the very first conversation, because typically you don't have a right of rescission. And once you sign those documents, that's your loan. There's no cold feet syndrome there. So make sure you have that conversation. All right. Now, Q&A. Before we get to that, I just want you to understand that over these last three weeks, there are just as many exceptions as there are rules, okay, in business lending. And every single, I don't care if you're buying the exact same franchise, every single business loan deal is unique and has its own nuance to it. And so you just have to understand that there are no such thing as cookie cutter, business loans. And I'm hoping that through this 3-week process, you have a little bit better understanding of, a little bit more transparency about what financial institutions are looking at, why they're looking at it, and the conversations you should be having during the process. So on the left, you'll see my contact information, my email, my phone. Please, if you think about something later and we don't get to it in the chat, just contact me. If you want to have a discussion about your business or about business loans, and talk with SCORE, give us a buzz if doesn't take anything for me to look at scenarios and just kind of talk with it through you. So that's my commitment to SCORE to help them out. So at this point, I just want to say thanks, and I'll open it up for questions.
All right. So I've allowed everybody to talk. If you have a question, just unmute your mic and ask away. Anybody? It's quiet.
It's a lot to digest in a short amount of time. So sometimes those questions pop up later.
All right. So you all have Dave's information. What I'm going to do is let us go, and look forward to seeing you on future workshops like this. Dave, thanks so much for doing this. Really appreciate it. And I'm sure everybody on the call has learned as much as I have. Every time I listen to this, I learn more and more. So much appreciated. Take care, everybody. If you have any questions, get a hold of Dave. You see his information up on the screen at this point. And I got 2 chats here. Hold on a sec. This is really helpful. Thank you and thank you. So,
Awesome.
and thank you. Okay, I got 3 thank yous. Thanks, everybody. Take care. Have a great evening. See you
All right.
soon.
Thank you. Bye-bye now.
Bye. Thanks, Dave.